Here is a question for you. If I handed you $100 right now and you stuffed it under your mattress for 10 years, how much would it be worth when you pulled it back out? The answer is not $100. It is closer to $74. Not because someone stole from you, not because the market crashed, just because of one word: inflation. Today I am going to break down exactly what inflation is, what causes it, how the government tracks it, and, most importantly, what you can do about it. Let us get into it. So what exactly is inflation? At its core, inflation is the rate at which prices rise over time and purchasing power falls. That second part is the one that bites you. Purchasing power is just a fancy way of saying what your money can actually buy. When prices go up, each dollar you hold buys a little less than it did before. That is inflation in a nutshell. In the United States, inflation is officially measured by something called the Consumer Price Index, or CPI. It is tracked and reported every single month by the Bureau of Labor Statistics. Let me make this real. Say you have $100 today at 3% annual inflation, which is close to the U.S. historical average. Here is what that $100 actually buys you over time. In 10 years, $74 of buying power. In 20 years, $55. In 30 years, just $41. Same amount printed on it. But the world has moved on and your dollar has not kept up. This is why just saving money is not actually saving money if you are holding it in cash long term. Okay, so what causes inflation in the first place? There are three main drivers. Number 1, demand pull inflation. This is when there is too much money chasing too few goods. When the economy is running hot, everyone is spending, hiring is strong, and demand outpaces supply. Prices get bid up. Think of it as a bidding war for limited stuff. Number 2, cost push inflation. This one comes from the supply side. When the cost of raw materials, energy, or labor goes up, businesses pass those higher costs on to you in the form of higher prices. We saw a lot of this post-pandemic with supply chain issues. Number 3, money supply inflation. This one is more macro. When a government prints a lot of new money, the total supply of dollars increases, but the supply of actual goods and services does not. So each individual dollar is worth less. You have probably heard people say, "They are just printing money." This is the consequence they are worried about. Here is something a lot of people do not realize. Some inflation is actually healthy. The Federal Reserve, the central bank of the United States, officially targets 2% annual inflation. Not 0, not negative, 2%. Why? Because a small amount of inflation encourages spending and investment. If prices are gently rising, there is a reason to buy now rather than wait. It keeps the economy moving. On the other end of the spectrum, you have deflation, when prices actually fall. That sounds great, right? But it is a trap. When prices fall, people delay purchases because they expect things to get even cheaper. That kills demand, tanks business revenues, and can spiral into a depression. Japan spent decades dealing with this. Economists call it the lost decade. So the sweet spot is around 2%, not 0, not 5, 2. Let us bring it home. Here is how inflation actually shows up in your day-to-day life. Groceries and gas, these are the most visible places. Food and energy prices are highly volatile. They can spike fast, and you feel it immediately at the checkout line. Rent and housing, real estate prices tend to rise at least as fast as inflation, sometimes faster. If you rent, your landlord can raise your rent. If you are trying to buy, here is the math. Higher prices plus higher mortgage rates equals a lot less purchasing power. Savings accounts. This one is sneaky. If your savings account is paying you 1% interest but inflation is running at 4%, you are effectively losing 3% of your real wealth every single year. The number in your account goes up, but your buying power goes down. And then there is debt. Here is actually an interesting silver lining. If you have fixed-rate debt like a mortgage, inflation works in your favor. You are repaying that loan with dollars that are worth less than when you borrowed them. The bank lent you $20 and you are paying them back in $30 that are worth less. That is not a bad deal if you locked in a low rate. So, how do you actually win against inflation? Strategy 1. Invest in the stock market. Historically, U.S. stocks have returned around 10% annually on average, which is well above inflation. Over long time horizons, equities are one of the most reliable ways to grow your real purchasing power. Strategy 2. Buy I-bonds or TIPS. These are Treasury securities specifically designed to track inflation. I-bonds are great for individuals. You can buy up to $10,000 per year, and TIPS are Treasury inflation-protected securities available on the open market. Neither one makes you rich, but they protect you. Strategy 3. Own real assets. Real estate, commodities, and real estate investment trusts, or REITs, tend to rise with inflation because they are tied to physical things in the world. Strategy 4. Do not let cash sit idle. A high-yield savings account paying 4 or 5% helps close the gap. It is not a permanent solution, but it beats earning nothing. And strategy 5. This one gets overlooked. Negotiate your salary. If your cost of living goes up 3% and your raise is 2%, you just took a real pay cut. Make sure your income is at least keeping pace with inflation. A quick note on how inflation is actually measured. The Consumer Price Index tracks a basket of goods and services that a typical American household might buy. The Bureau of Labor Statistics surveys around 80,000 prices every single month across the country. The basket is broken down by category. Housing makes up about 32%. Transportation is 17%. Food is 14%. Healthcare is 9%. Education is 7%. Apparel is 4%. And the rest falls into a catch-all other category. When you hear inflation is 4%, what that really means is this basket of stuff costs 4% more than it did a year ago on average. Some things in the basket might be up more, some less, but overall the average is up 4%. There is also a measure called core CPI that strips out food and energy because they are so volatile. Policymakers often focus on core CPI to see the underlying trend. All right, let us bring it all together. 1. Inflation means rising prices and falling purchasing power. It is always happening right now. Every day. 2. The Federal Reserve targets around 2% annual inflation. That is the healthy zone. Above 5% and things start to get painful fast. 3. Holding cash long-term is a guaranteed way to lose real value. Your emergency fund belongs in a high-yield savings account, not under your mattress. 4. The best defenses against inflation are investing in stocks, owning real assets, and using inflation-linked bonds for the conservative portion of your portfolio. 5. Your salary needs to beat inflation. If it does not, you are effectively earning less every year even if the number on your paycheck goes up. That is inflation, decoded. Next up on Wednesday, we are talking about credit scores, how they work, what actually moves the needle, and how to improve yours fast. See you then.